Welcome to Invest Growth Wisdom, where we delve into the fascinating world of investments, aiming to maximize returns while keeping risks at bay. Today, we're going to explore a crucial term in finance, GARP. This concept is a game changer in long-term investing, and it's something every savvy investor should understand. Many investors are familiar with the popular S&P 500 ETFs like SPY or VOO. But what if I told you there are alternatives that can outshine them? The key is to put effort into research, and today, I'm going to make that process easier for you. Usually, the S&P 500 index is the benchmark for investments. When we talk about beating the index, we refer to offering superior risk mitigation in bear markets and outperforming in bull markets, or in other words, implementing the GARP strategy, which stands for growth at a reasonable price. GARP combines the best of growth and value investing, utilizing fundamental analysis. This blend, I believe, is the secret to maximizing portfolio returns. While it's challenging to find investments that meet this criterion, it's not impossible. And today, I'm thrilled to introduce an ETF that does just that. So, let's dive in. Growth investing typically translates to strong earnings growth. However, growth alone is a double-edged sword. Take the NASDAQ 100 index, the QQQ, for instance. It's a benchmark for growth and has provided impressive returns. But, as seen in the bear market of 2022, it lost over 33% of its value. And although it bounced back by 31% the following year, investors who joined at the onset of 2022 wouldn't have broken even. The volatility is real, and that's why understanding the risks involved is crucial. On the flip side, value investing can shield you in bear markets, but often at the cost of missing significant growth when the sentiment is right. For investors who aim to achieve steady returns over the long term, it makes sense to have a portfolio which combines the benefits of both growth and value investing. Is there an investment that not only outperforms the S&P 500 and QQQ but also remains resilient against major market downturns? It almost sounds too good to be true. That's where SPGP, the Invesco S&P 500 GARP ETF, comes into play. This ETF stands out among others, and surprisingly, not many investors are aware of it. This is a true hidden gem in the investment world. Established on June 16, 2011, SPGP has a solid track record for investors to analyze. This fund has $3.5 billion in assets under management. We know past history doesn't guarantee future results, but it could tell us how SPGP performed against major indices to show its resilience. In the bear market of 2022, while S&P 500 lost 18.7%, SPGP limited its loss to just 13.5%. This ETF is not just about technology stocks, it's about identifying those with true growth potential, quality, and value. This ETF tracks an index that targets growth at a reasonable price. The index selects the 75 growth stocks within the S&P 500 that exhibit quality characteristics and have attractive valuations. The fund predominantly allocates its assets towards energy, 28%, and technology stocks at around 19%, with a sprinkling of basic materials, 13%, healthcare, 11%, industrials, 10%, and consumer cyclical sectors. But how does SPGP identify growth potential? It uses two primary criteria. The first one is 3-year earnings per share growth. It checks how much a company's earnings per share, EPS, have grown over 3 years. Earnings per share is a company's net profit divided by the number of common shares it has outstanding. EPS indicates how much money a company makes for each share of its stock and is a widely used metric for estimating corporate value. This shows if a company is making more profit over time. SPGP looks for more than just high EPS growth. It wants companies that can grow faster than average. But not all companies qualify. For instance, IBM, although a big tech company, doesn't fit because its EPS growth has been down over the past 10 years. The second criterion is 3-year sales per share growth, which shows how much total revenue a company makes for each share. Sales per share is a ratio that computes the total revenue earned per share over a designated period. It is calculated by dividing total revenue by average total shares outstanding. It is also known as revenue per share. But higher sales don't always mean higher profits. Sometimes, sales go up because a company spent a lot on things like buying another company. That's why SPGP looks at both EPS and sales growth together to get a clearer picture. When it comes to quality and value stocks, SPGP uses something called the QB composite score. This helps lower the risk of big losses. Here's what this involves. Financial leverage ratio. This tells us how much a company depends on borrowed money for its operations and growth. More debt can mean higher returns, but it also brings more risk. When interest rates are high, debt can really hurt a company's earnings. Next is return on equity. This shows how good a company is at making money and using investments effectively. It calculates the profit a company makes for each dollar shareholders invest. Companies that are efficient and profitable are usually well managed. And lastly, price-to-earnings ratio. This is a common way to see how much investors are paying for each dollar a company earns. SPGP goes further by also looking at the price-to-earnings growth ratio, which gives a fuller picture. By mixing growth with quality and good pricing, SPGP aims to invest in stable companies less likely to face big financial problems. This thoughtful mix is what makes SPGP an attractive choice for investors who want growth, but also a safety net. Now, if you're enjoying this deep dive into smart investing strategies, don't forget to subscribe to Invest Growth Wisdom. We're here to guide you through the intricate world of investments with insightful content like this. Now here's a twist that sets the stage for our deeper analysis. 3 years ago, the SPGP ETF made a major change by switching its benchmark index. This means we should only look at its performance after June 2019 to get an accurate picture. In these 3 years, SPGP has done really well. It gave a 40.87% return, beating both the S&P 500's 21.42% and the QQQ's 22.16%. It even did great after the pandemic and during the tough market of 2022, where it limited losses compared to others. This shows SPGP is good at handling risky markets. Compared to the S&P 500 or QQQ, SPGP stands out for its strong performance and stability. It's especially interesting because it doesn't just rely on the high-value Magnificent Seven stocks that boost the QQQ and S&P 500. But SPGP's approach of picking companies based on growth and value gives it an edge. Another interesting point, SPGP changes its investment focus based on market trends. As of October 2022, it leaned more towards financials. However, at this time this preference shifted, emphasizing energy over financials. This changing strategy leads to a high turnover rate, meaning the fund buys and sells a lot. While this active management boosts short-term gains, it comes with a price. SPGP has a 0.34% expense ratio, which might not be great for long-term investors. Also, because it changes its investments often, it doesn't have a strong or regular dividend yield. Looking ahead, SPGP's future performance, under its new index strategy, is something to watch closely. While 3 years offer a glimpse of its potential, it's not enough to fully assess its long-term performance. However, the signs are promising, and it's certainly a fund worth keeping an eye on. And there you have it, an in-depth look at the SPGP ETF and its remarkable ability to outperform industry giants while minimizing risk. For more insights on investing, market trends, and strategies to grow your wealth, make sure to subscribe to Invest Growth Wisdom. We're here to empower your financial journey with wisdom and insights. Until next time, keep growing and investing wisely.